Indians love burgers and wraps, especially when suited to the Indian taste buds, but not as much when discretionary spending is waning. McDonald's has therefore opted for value packs and combo meals, not only to keep the consumers loving it, but also to ward off competition from Burger King. The bets had some success, with same-store sales growth increasing in the last quarter, but it's nowhere close to the double-digit numbers clocked till about a year back. So what's McDonald's franchise owner Westlife planning to do to get back to the high teens growth path? Let's get the company's vice chairman, Mr. Amit Jatia, to join in and talk about all of that and more with us. Mr. Jatia, thanks very much for taking out the time. So quarter two, despite the demand sentiment being slightly weak and the demand environment being slightly weak, was okay with regards to the same-store sales growth, which came in at 7%, obviously nowhere close to the teens that we're talking about, but you did okay on a sequential basis. Margins saw a sharp expansion as well. Just talk about, what the game plan is going forward in this current environment.
Sure. I mean, if you think about it, it's been 17 quarters of positive same-store sales growth. And if you look at like the first quarter of this 17th quarter, we've grown same-store sales by 58%. So I feel that in a very volatile market, for a brand to be able to consistently deliver 17 quarters itself shows that the long-term foundation of what we are trying to do is quite strong to be able to get consumers in. And if you look at the 7% in that context, you'll realize the power of the 7%. Because, for example, now we are 58% more than we were 4 years ago. So to grow the 58% by even 7 or 8% in the next quarter or in the next year is quite a daunting task, because you have to maintain that base as well. So I think we are quite proud of what we've been able to do. And this is obviously built on the foundation of our long-term thinking. In 2016, we came out with Vision 2022, and we have solidly worked hard on keeping that as the primary goal, rather than sort of focusing on sort of ups and downs in the economy. And the crux of all this is really building new occasions for the consumer to use the brand, whether it's breakfast, whether it's coffee, whether it's consuming outside food at home, and so on. So that's really what's worked for us in the last few years.
Mr. Jatia, just talk a little bit more on what the focus is going to be with regards to making new investments. I mean, in terms of, you just spoke about the same-store sales growth, but with regards to store expansions, whether or not you're going to indulge in further promotional activity, where is the price point that the consumer is getting most attractive to? Talk about all of those factors.
Sure. I mean, the QSR market in India and the Western fast food market in India is still very nascent. If you look at the total size, it's only $1.8 billion to $2 billion. But the good news is that the growth in the sector, even at this point in time, is at least single digit. So while we may complain about single digits, the fact is that most other industries don't even have that. Now, if you look at that backdrop, we have really two big jobs to do over the next 3 to 5 years. First and foremost, obviously we are under-penetrated. I mean, 300 restaurants in all of West and South, clearly that's a big job for us to get to the 600 to the 1,000 restaurants so that we can be convenient to more and more customers. So that is one big job, and you will see that even through the period of 2014, 15, 16, 17, when things were really, really tough, same-store sales were down, we opened over 100, 120 restaurants. So you will see that continue from us, and I don't see that stopping in the foreseeable future. So that is one big part of it. The other part is that when you are in the business of retail and you have consumers coming in and using you with so much competition available and around, I feel no retail brand has the option but to reinvent themselves, in fact, every day. And that's why I always say that we will evolve every day, and over a 2 to 3 year horizon, you will not recognize the brand that you saw 3 years ago. So if you think about it, while 2 or 3 years ago, the conversation was all around a McCafe re-imaging, today the conversation is about giving consumers an experience of the future, where they can order on a digital platform, sit down on the table, get table service, and therefore their experience gets elevated. Along with that, you will see us continue to grow the coffee business. We feel that we have a tremendous advantage of having really great locations and being able to give handcrafted barista-made coffee in this environment has really resonated with our consumers, and it has added a new occasion for use for McDonald's. So you will continue to see growth in this area. Value, of course, will continue to play an important role. So let me sort of deconstruct value from a consumer point of view. In India, the snacking market is something that we expect to grow really, really largely. And we think that the brand fits in quite nicely with our penetration, where if the consumer wants a quick meal, McDonald's should be their first choice. And therefore, the McSavers combos play that role in the consumer's life. And what it does for us is it builds McDonald's through the afternoon day part, through the snacking day part, which is between breakfast and lunch. So what you will see if you kind of zoom out and look at it holistically, that we are trying to capture every consumer's occasion of use, whether it's breakfast, whether it's coffee, whether it's a snack, or during lunch and dinner. Again, from a lunch and dinner point of view, as we are trying to build that business, you saw us introduce rice because that's a more filling meal for the consumer. You will see us take leadership on the wrap side. And of course, the key is to keep all this affordable. And therefore, you will see us bring value that is unparalleled for the consumer. So, this is the journey that we expect to see over the next 3 to 5 years. In our Vision 2022, we've stated this quite clearly, that the restaurant base will be between 400 to 500. We will have about 300 to 350 McCafes, about 350 delivery points, and of course all the things I just talked about from a menu point of view. So that's what you can expect to see from McDonald's over the next 3 to 5 years.
Right. You've also managed to have a strikingly good EBIT margin for Q2, but your target for about 13 to 15% EBIT margin. Is that also on track? I mean, you have to reinvent yourself in terms of the product mix, and you've done that, and that's what's aided in this quarter. You've had, good cost management despite input cost inflation moving up. So how do you intend to do that and keep the pace going?
Sure. I mean, for us, it's all about step by step, and we don't believe in doing knee-jerk reactions. So if you look at the last 3 years, we've been able to improve our EBITDA margins by about 120 basis points a year. And I think if you look at the trajectory this year again, we have kind of delivered a bit more than that. So we are quite confident that you will see at least 100 to 200 basis points improvement year on year. And that's primarily driven because of one, of course, the product mix, as you rightly pointed out, but also tremendous focus on keeping cost structure tight. The whole idea is that when you grow sales by, say, even same-store sales by, say, 7% or 8%, you got to keep the cost growth to about 2 to 3% so that the incremental 5% goes straight to the bottom line. And as I have explained earlier, once we cross the threshold of about 6 to 6.2 crores per restaurant per year, the flow through to the bottom line continues to increase at a much higher and in fact a phenomenal pace. So we shared that in one of our investor presentations, I think a couple of years ago. As we are closing into this threshold sales number, you will see us finding it a little bit easier to continue to get this margin growth going, which is what we sort of factored in our Vision 2022. So yes, I'm quite happy to say that we are quite confident of delivering our Vision 2022 with respect to margins as well.
Amit, good morning. Neeraj here. Would you be able to give us a breakup of how your metro versus non-metro store breakup is, and if the same-store sales growth is disparate between those two geographies, if I can loosely use that term?
Sure. I mean, I know I hear a lot about rural demand not coming through and it's more urban, but to be honest, I don't see that, at least in our business. We do have restaurants in reasonably small cities like Nadia, Mehsana, Bharuch, Kolhapur. But from our point of view, we are not seeing that the non-rural areas demand or same-store sales is stronger than the rural. I don't know if it has to do with QSR and Western fast food, but for us it's reasonably even. We don't share individual breakups, but I don't see any trends that show me that rural demand is dipping, at least in our business.
Okay, so demand is not dipping and the same store sales growth would be high there too. Part two of my question therefore would be, would you believe that as you expand more into the non-metros, because you would have reached a critical size or critical mass in metros any which ways, that your margins would anyway see a bit of a leg up because the cost of employment as well as the rentals would be low there, and it might be a bit more aspirational, a product or a place to go to in tier 3, tier 4 as opposed to tier 1 or metros?
No, so I mean, I see it slightly differently, to be honest. I believe that real consumption lies in the 6 or 7 key cities. There are some other smaller cities or what we call core cities, like a Surat or a Baroda, that also have good demand, and therefore 60 to 70% of our growth is going to continue to come in these cities. So while the cost structure in these cities is higher, but the average unit volume in these cities is also very, very high. Versus smaller cities, while the cost structure is lower, but then the average volume also takes a little bit longer to build. Yet at the same time, in our own way, thinking about a marathon or an inside-out growth strategy, we've been consistently been adding new cities to our mix. So for example, we opened Raipur, most recently Nagpur. Now we have 3 or 4 restaurants in Goa, while 3 years ago we had 0. So, but once we get into a city, then we tend to go and own it. So if you imagine in a small place like Vapi, which is a little bit north of Mumbai on the way to Gujarat, we have 2 freestanding drive-thrus across each other, and both are doing really quite well. So I feel there is a method in the madness. And, for example, if I look at Mumbai, we have the largest base of stores at about 92 over, our similar competitors in the burger business. And we expect that 92 can easily go to 150 to 200. Again, while Mumbai is very hard to penetrate, but because of the strength of the brand, we are able to see much higher average unit sales, and therefore we are able to absorb the higher cost and actually make good money in these cities as well. So a tougher job, but I think that's the way to do it.
All right. Mr. Jatia, just last few questions before we wind down on this interaction. Firstly,
sure.
What's the competitive landscape looking like in terms of costing and making sure that you have more of the deals, more promotional deals coming up, and how would you tackle that? And second is, how do you view the pressure on dine-in segment and the shift towards delivery, and how do you think that will shape up in the upcoming years?
Sure. So firstly, to be honest, I truly believe that. I think competition is really great. And I feel that if we did not have competition, we would not be on our toes and we would not be our best for the consumer. And therefore, I feel that at this stage and development of the Western fast food business, competition is actually growing the market. Obviously, we have to make sure, as I mentioned earlier, that we continuously reinvent ourselves. We are cost competitive. We keep the consumer experience at the forefront, and we essentially ensure that our product offerings to the consumer is in line with their expectations and they resonate with that. And I love that about it, because otherwise we would have never accelerated experience of the future and all the menu work and all the things I talked about in the past. So while it is competitive, we deal with that globally, and we feel taking it head on is actually good for the business, for the industry, and for the consumer. From a delivery point of view, I have always maintained that it's fantastic. Just think about it this way, that if that demand and that business was not available, we would have lost almost $1 billion of market of eating outside food at home. So on the big picture point of view, it is great to see that consumers want to eat outside food at home, and aggregators and apps like ours also make it convenient for them to order. The question therefore is that when that demand is there, you got to fit your business model to capture that demand. And our internal target has always been that, okay, this business is there. This is the reality of the cost structure in this business. How do we ensure that it works for us and we make money while owning that market? So from my point of view, I think that's growing well because it's a small base. while the larger base of in-store dining, of course, has a little bit of pressure right now due to the headwinds, but I expect that to continue to grow at least 7 to 8%. And I feel that at least McDonald's will play in both through all the initiatives I talked about. For example, if you look at coffee and McCafe, we are taking it from 200 to 300, and that's an in-store strategy more than a takeaway strategy or a delivery strategy. Meanwhile, rice can be delivered very nicely over lunch, and so does breakfast. So I think we have to factor that that's a new business opportunity, and we have to play both sides equally well. So that's my take on it. I love it actually, and it again forces us to fit the business model into the growing consumption for outside food at home.
Right, Mr. Jatia, it was a pleasure chatting with you and getting your thoughts on the platform. Thank you so very much for joining us this morning.